Welcome back to Dukas Copy TV. Coming up next, we have yet another interview in collaboration with the financial newspaper Agefi and Dukas Copy TV. This time, financial journalist Nicolette de Joncaire is talking to Lombard Odier man Sami Chaar.
Throughout developed countries, central banks have responded to the crisis with an unprecedented level of activity. Sami Chaar, strategist at Lombard Odier, is here with us to share some fresh views on a much debated topic. Sami, hello, thank you for joining us.
Hello, thank you for inviting me.
Why have central banks intervened so massively?
Thank you for your question. Well, to understand why central banks have been pushed to act the way they have, we need to get back to the roots of the ongoing financial crisis. Now, the crisis stems from decades of debt accumulation shifting through the economy. The over-indebtedness today is concentrated in two areas. On the one hand, we have over-leveraged sovereigns with high levels of debt, important deficit levels, and more importantly, some of those countries are still in a unsustainable fiscal situation as their growth rate is far below their financing costs. So every year they have to pile up new debt to the already existing debt. So on the one hand, we have over-leveraged sovereign. On the other hand, we have over-leveraged banking sectors still waiting on sovereigns' balance sheets. Banks are too big, too leveraged, and their balance sheets are deteriorating. We're seeing alarming decline in PIGS banks' deposit. Now, the problem is so large and so widespread that it cannot be tackled by conventional solutions such as austerity and growth. The past 2 years have proved the ineffectiveness of austerity to improve public balances in countries like Spain or Greece, typically. And frankly, at those debt levels, growth programs will simply not be financed. So the problem is so large that traditional solutions are inapplicable. Now we are left with two other choices. One is default, whether orderly default or disorderly default, and concerning Europe, whether within the Eurozone or outside of the Eurozone. Unfortunately, there's no political will for default. It's wrongly, in our view, seen as too painful and too difficult to implement. So the only other alternative, and the only one that has been implemented so far, is massive central bank activity. And central banks have been pushed to sizable liquidity injections. Those liquidity injections obviously do not address the solvency issue, but they temporarily and artificially remove the systemic funding pressures for banks and for sovereigns.
But what impact does this have on the quality of the central bank's assets?
Well, obviously, to offset all of the fragilities that come from the debt excesses, central banks have been doing two things. They've been growing the size of their balance sheet, expanding the monetary base. This is traditionally called quantitative easing. But also, they have been deteriorating the quality of their balance sheet via their purchase program of risky or riskier assets. Typically, the Swiss National Bank deteriorated its balance sheet by holding vast amounts of euros. The European Central Banks deteriorated its balance sheet by holding peripheral debt and other instruments related to the European sovereign crisis. And in the US, the Federal Reserve deteriorated its balance sheet by holding mortgage-backed securities to put a floor to house prices.
What are the consequences of such a large injection of money supply?
In the short term, we don't see those liquidity injections as having a major high street inflation, real inflation problem. Obviously, the liquidity injected by central banks offsets the unwillingness of banks to lend to the real economy. So the overall liquidity in our systems is more contracted than one might think. If there's no street inflation risk in the short term, if central banks continue to expand and deteriorate their balance sheet at this pace, inflation might become a longer term issue. Now, more importantly, there are immediate side effects to those liquidity injections. I mentioned that those liquidity didn't fuel the real economy because banks are reluctant to take on credit risk. But they do spur into financial markets, and assets, now typically commodities, currencies, housing, equity and bond markets, are very sensitive to what central banks are doing. So asset prices are distorted by those liquidity injections. Bubbles might be fueled, maybe in the housing market, maybe in the bond market, maybe in the currencies market. And we know that when a bubble deflates, it always tends to hurt the real economy. Now, finally, even if central banks have the privilege to issue the currency, deteriorated balance sheets are always a concern, whatever the economic actor. And if things were to turn really sour, losses might have to be taken on some assets. And we could imagine that some central banks might even need to be recapitalized.
Well, the ECB's meeting today, in the light of what you've just said, is it likely to take any further action?
Well, let me recap. We have a debt accumulation that we didn't want to deal with. Rather, the problem has been transferred from one economic actor to the next, from commercial banks to sovereigns and now to central banks. Without proper debt restructuring, the problem is here to stay, and the problem is even intensifying. So central banks have no other alternative than to continue to act. If it's not at today's meeting, it will be at the next.
Sami, thank you very much for joining us today and sharing your views.
Well, thank you. It was my pleasure.
Well, some interesting things on central banks said there by Sami Chaar from Lombard Odier. We'll be back with Agefi again next week for further interviews. But for this week, it's Dukas Copy interviews and updates all the way. Until next time, though, goodbye.